WCLN 1170 Radio and Cable Channel 16 are pleased to present We Should Know, hosted by JW Simmons, an upbeat, informative look at people, places, and issues facing our community. This education-based analysis of issues will remain positive and informative as we consider closely what we should know.
Ladies and gentlemen, welcome back. We Should Know is on there. I want to thank you for being with us today. We're coming to you from Star Communications, Channel 16. On the TV side, WCLN Radio, we're simulcast on Tuesdays at 2:30. Today we're talking about finances, money, estates, all things that involve numbers. And we got a person that knows something about analytics and numbers, and that's Michael Chestnutt, CPA. For 32 plus years, Michael, you've been dealing with very wealthy amounts of money for people. You've been basically making sure they're in compliance with all the tax guidelines that constantly change. But recently, I understand you've kind of shifted to financial planning and estate planning, kind of a new persona for Michael Chestnutt. Why the move?
Well, honestly, I think a lot of it has to do with what, the slowdown and people deciding that maybe they wanted to take a little bit different career path with everything that happened with the coronavirus. What happened, I guess, in our industry, and you had kind of the confluence of all the things, whether it was PPP or credits or advanced rebates, all the different things that would have occurred. And those things came back through the tax system. I've been an accountant for 32 years. Been in public accounting for 26 of those, actually 28. And so when you take a heavy workload and then when you add a whole lot of extra to go along with it, you start, reviewing things and asking yourself, is it truly worth it? Mm-hmm. And when you already work 80 hours a week, do you really want to work 81, 82, 83? So at that point in time in my career, I decided I wanted to change. I've been doing financial planning and estate planning. That's always a subset of what a public accountant is going to do for his clients. I've been a certified financial planner since 2005 and been doing financial planning really as kind of a concentration all the way back to 2000. So 22 years doing that in my practice. So it's not really anything new in terms of what I've been doing. I would affectionately refer to that as kind of the fun stuff, the value-added stuff that I think I really want to do, kind of as the last stanza of my professional career. And I made a decision that I wanted to slow down my tax practice and sold my interest to Todd Johnson and Kendall Tyson. And I still am associated with the firm. I still do my tax work through the firm, but I'm not taking on any new tax clients. How about that?
It's interesting because just listening to you explain that and looking at the complexity of what a public accountant does in assuring that their clients, quote, meet all the regulations and guidelines and doesn't violate the law. That sounds like a lot of weight for one person to carry.
Well, it is. I mean, you end up having, financial relationships, personal relationships. Some of these things kind of transcend both sides of a total client relationship. And it is a lot. I mean, probably the easiest thing that most people, if they're in business, will understand that you can stump your toe on is something as simple as payroll tax obligations. You're sitting there trying to do the right thing and pay your employees, and you miss a payroll tax deposit, you get a notice. What do? Right now, customer service with the IRS is pretty atrocious. They really haven't recovered fully where people are totally back in the office entirely. So if you call, you may not be able to get through. It may take you days to get through, and it's quite frustrating. So you get notices as a business owner, and you either don't know how to handle them or you try to handle them and you get frustrated. And so we kind of have to help, with some of those. That's just an example of something simple that could turn into something major, and next thing you know, you got a crisis on your hands.
One of the things also that strikes me is a lot of the folks that maybe are watching and listening to the show, they may not understand that a lot of the clients you had as a public accountant, there's a lot of wealth in agriculture, and there's a lot of money that changes hands in agriculture. The movement of that and the analytics of it, just from somebody that has no skills with analytics, I look at it and go, wow, how do you figure it out? You just mentioned the IRS. They're so overwhelmed and understaffed just to answer questions or to clear issues up. You don't have anybody. Who do you turn to? You know, I mean, it's like a double-edged sword.
I hope they take, if they're going to hire some of these 87,000 agents, I hope they point them more towards helping folks try to understand and become compliant and assisting when there is, you know, problems, and not just fully on audits and things like that. Not that that's not necessarily needed from the standpoint of generating revenue. It is, but it's frustrating. I mean, it's so complex. You know, people just throw their hands up at times, and you know, it's the wild, wild west out there. So if you don't know, I mean, this is one of those cases where you've heard the old adage, innocent until proven guilty. You're guilty until proven innocent with the IRS.
And the only thing that a person has got to fall back on, if they are a person, and I'm talking millions of dollars that's often moved through ag industry and ag business, and we're fortunate for that, $100 billion industry in North Carolina. But at the end of the day, that accountability part of it is what you have to, I guess, what you sign up to defend if that client is following the instructions as, quote, an expert in that field. Yeah,
I mean, agriculture in and of itself is a specialty, even with tax. There's some things that you might take in some other industry that you don't have the ability to do. You may have the ability to do something as simple as farm income averaging on your personal tax return, where you get to average it over multiple years. So if you're trying to do it yourself, you may not understand it, or may not understand, you know, the complexity that goes along with it. But also, I mean, there's some nuances of what you can write off differently than other industries would be able to. There's some trade-offs with that too. You had mentioned kind of before we started, you've got someone that decides they want to sell a farm one day. Well, it's not as simple as you deciding you want to be the bank. And if anyone is out there with a hog farm or a turkey farm or a chicken farm or something as simple as a tractor, you need to talk to your accountant before you make the decision that you want to sell it, because there could be some tricky tax consequences that go along with it depending on how you structure the sale.
So the analytics of it is so specific. That same analytic we're talking about as a public accountant also transfers to financial planning and estate planning.
Oh, I don't think there's any question. I mean, they go hand in hand, and that's part of the reason I said, you know, for years I've been doing financial and estate planning. Obviously, as a CPA and a CFP, I can't prepare the documents. I help you decide what you want to do and develop a roadmap as to where you want to go. But I have to work with other attorneys I'm not that I'm an attorney, but attorneys to see that you kind of document your roadmap and where you need to go. But you really have to think about structure. I mean, there's a lot that goes into it. You, for instance, might decide you're a hog farmer, but I need to determine exactly how you're a hog farmer. And what I mean by that is you might have a hog farm in your personal name. You might have a hog farm in a partnership with you and, say, a child. You might have a hog farm in you know, a C Corp, an S Corp, or different types of entities. Well, the estate planning that goes along with that will completely differ what the end result will be. So from that standpoint, just because you're a farmer, I can't look at that and say what the ultimate outcome is going to be in terms of how we need to put your estate plan together, because each one of those things will differ in terms of what the final result will be. And we need to take that into consideration in how you structure your documents and how you ultimately determine what could be income tax benefits later on for you.
And we've got a lot of stuff that we need to cover, and I'm going to go ahead and tell the folks listening and watching, and we're not going to get into everything that we want to cover today, but I don't want to get away from this before we touch on a couple of issues. Are we in a situation, Michael, that, and looking at your career and the years you've been doing this, that the government is too much involved in the business sector? And I've heard people say if you could get the government out of the way, we could do a lot better job. Is there any reasoning and rationale to that observation?
Well, I mean, I know we have to have rules. I mean, I think at times we all feel like there's too much government intrusion. I probably think from a privacy standpoint, personally, I think the government is probably too much in our information from a privacy standpoint, and that's an area that could certainly be abused. The thing that has always bothered me about the tax system in general, whether you agree or disagree with something like the estate tax, I hate the I gotchas that come along with income tax.
Yeah.
And, so when you inadvertently fall into a hole that you didn't even realize was a hole, I have a problem with that. And one of my favorite examples is there's certain exclusions, like if you use money out of a 401k or an IRA for educational purposes, you get to exclude it from the standpoint of a 10% penalty if you do it before you're 59 and a half. Well, there is a specific exclusion that applies to an IRA that doesn't apply to a 401k. The guy goes to tax court. He says, Your Honor, all I would have had to have done would have been to roll that same thing into the IRA. Both of them are tax-deferred assets, and I'd have got the same treatment. He says, You're right, but you didn't, so you lose. And so both of them are similar items, but gave you drastically different results. I don't like the cuteness of that. I personally think that's absurd. Now, I know rules are rules, but Congress has made a mess of it. And honestly, every time they try to engage in simplification, they make it worse. I mean, the Trump tax bill, there is some great things about it, but it made my life harder. And it made the average person that's trying to do it themselves almost impossible.
I think that's kind of where we are when we're talking about a number of these issues, is that there seems to be a sense for the taxpayer, for the average taxpayer, and for the larger taxpayers, is that there's so many things that are traps that they see as just set to catch them in the wrong situation or the wrong move. So they've not only got to have folks like you, but they've got to also back up and look at how many people. Do I need certified public accountant? Do I need a certified financial planner? Do I need a couple of attorneys to look at everything? And then if you do that, then you're also then bringing in more, I guess, stuff you got to pay out. So when we come back, I want us to get into some of these things in detail for the average person. Ladies and gentlemen, we'll be back in a moment. We're talking about things that can impact your life, whether you make $5 million or $500,000. We'll be back in a moment.
If you run a business, you need sales. To get sales, you need customers. To get customers, you need exposure. Let our team of experts craft and produce the perfect video ad to reach your intended audience while making the most of your advertising dollars. Call 1-800-706-6538 or visit starcom.net to contact our Star Communications production team and get your business moving to the next level.
Ladies and gentlemen, welcome back. JW Simmons here, your host. The show is called We Should Know. We're talking with Michael Chestnutt, CPA, Certified Financial Planner. Michael, you've been on the show before. Every time you're on, we always know that we've got more stuff to talk about than we can unpack. On break, we were talking about whether you made $50,000 or $100,000 or whether you made $5 million or $100 million. There's always an amount of money that is, quote, due the government. The point that you made, and I want you to just touch on that quickly before we get into some detailed stuff. The point you made is there's always a gray area of what that is. If it's 20% or 10% of 100,000, there's always a gray area of that percentage that is actually owed to government and when it's owed.
Yeah, I mean, what I was leading into earlier is the problem I see with taxes in general is sometimes the timing of income is the issue that you have to struggle with. So I think we could probably all agree if the math were consistent, if you had $100,000 of income and a 20% tax rate, you got $20,000 in tax. The problem with income taxes, when is it income? You have some people that have to do it on the accrual basis, meaning when they earn it. Some people that get the opportunity to report it as they're paid. Most people on a W-2, that's cash basis income tax. The problem with it, it's not always clear when it's income. So the determination of when something actually has to be recognized for tax purposes is complicated. It's very complex. And I had mentioned the example kind of as a tease to you earlier about a farmer selling a hog farm. You've got a situation where you want to sell it after you've owned it for 20 years and you want to be the bank. You could have an adverse tax consequence even though you've not received any money yet, because the IRS would view an installment sale for certain types of assets as income the day you sell it, whether you've received a dime or not. And so timing of income is critical in terms of determining what your overall tax consequence would be.
So out of that money that you've worked all those years and paid that farm off, you may end up 6 digits going to the federal government somewhere or more.
Well, quite honestly, you could. And in a lot of cases, most farms around here now, when you look at hogs, chickens, turkeys, I mean, it is pretty commonplace for it to be a 7-figure transaction where someone's selling a farm that they've had for years. And I'm happy because obviously that's a big part of our property tax base. Sure. And I'm happy for the guys that the values are holding strong, but make no bones about it. I mean, all the depreciation they've taken through the years, when it comes roaring back in when they sell it, I mean, they end up getting whacked by usually somewhere around a third by the time you get through with farm income average. And in some cases, it could be more than that. But a lot of times when I'm doing these transactions for small farmers, it's somewhere around a third to 35% is what I see of the gain that you have to end up paying Uncle Sam and the state.
Is it getting harder to understand what's going on that side of the curtain that's called the IRS? I mean, at some point in time in history, you kind of knew what the expectation was. It sounds like now you could think you're following all the rules, even from a CPA point of view, and all of a sudden you get hit with something, you're going, where did that come from? Is there something there that you missed as a professional?
Well, yeah, I mean, there's plenty of opportunities to miss things. I mean, when I first started in public accounting in 1990, I mean, you didn't have to worry about very many taxpayers at all getting, caught up in alternative minimum tax. But when you prepare your tax return, and make no bones about it, if it weren't for computers and calculations that are kind of happening behind the scenes, you trying to do your personal tax return on a paper form and send it to the IRS is almost laughable now. Yeah. But just to kind of run through just a quick litany, you have a regular income tax, you have the potential for alternative minimum tax. After the Trump tax bill, you had qualified business income. So certain types of businesses, really all active trader businesses have the ability to have some of that income taxed at reduced rates. The Obamacare brought in potential Obamacare taxes that would go along with it. So you've got net investment income tax. So and I hadn't even talked about capital gains. So you've got short and long-term capital gains. There's 5 to 6 different things that I would have to reconcile to make sure we've got all the inputs right to determine one tax number. So, wow. I mean, your ultimate balance due of all those things combined to get one combined tax number minus what you paid to determine how much you owe. So it's not as simple as at least the system we have today of like a national sales tax. So you've got a bunch of different things that's going on your return at one time. Mm-hmm. And I have no idea. I did it for a living for a long time. And honestly, it's more complicated than you can keep up with. And I'm a professional. Right. So there's no way the average person could do it on their own and feel good about it.
Even if you just had to fill in the blanks, you still...
Oh, you'd have a lot of blanks to fill in.
Yeah, exactly. And you still could put it in the wrong block.
Yep, and probably will. If you try to manually fill out a form, other than, a standard 1040, now one good thing that they did do is they upped the standard deduction, which eliminated a lot of people from being able to itemize. So for someone that is just a W-2 with very little else on their tax return, it actually simplified those tax returns. But for someone that was a mom and pop that had a dry cleaners and things like that on their personal tax, it made it more complicated. Mm-hmm. Okay, it made it more complicated in a beneficial way to it, but it made it more complicated. Mm-hmm. So I mean, compliance is a problem. I mean, anytime you add complexity, you're going to get differential results, and so it's all over the board. I mean, you can go to 2 different tax preparers and maybe get 2 different results based on how they interpret things.
Wow. Yeah. Well, with that said, let's talk about some specifics here that folks maybe need to anticipate as they file their 2022 taxes. What are some of the things that has changed with North Carolina taxpayers that they should anticipate in 2022?
Well, North Carolina, I mean, they're on a race to reduce rates overall, whether it's individuals or whether it's businesses. They started earlier with businesses, and now Probably the biggest adjustment is reducing the income tax rate. We were at 5 1/4. We were much higher than that at one point in time. I think when we had a tiered rate structure several years ago, we went as high as 7.75% for the highest rate. That got reduced. For 21, we were at 5 1/4. For 22, we'll be at 4.99, with it scheduled to go even lower than that. So the first thing would be the rate adjustment. So North Carolina has what is equivalent to a flat tax, whereas on the Fed, you have ordinary income and capital gain income, and you have different rate tiers. So you could go from a 0 rate all the way up to a 37% rate. And then depending on whether it's long-term or short-term capital gains, the rate could be even different from that. Regardless of the type of income on North Carolina, you essentially have a flat tax. So the flat tax rate for 22 is going to be 4.99%, which is, a 25 basis point reduction from what it was last year. That's the biggest thing. They've also tried to increase their standard deductions a little bit more. And I think the trend really, supposedly the Fed adopted some of the ideas from North Carolina when we did that. We upped our standard deduction levels in North Carolina such to eliminate people from being able to itemize. You still see a fair number of people that can itemize, but a lot more people, both Fed and state, don't itemize because of the standard deduction being so much higher. And you might ask, why would they do that? Well, they can sit in Raleigh or in D.C. and audit the returns, because I can look at your W-2, I can look at some 1099 documents compared to what you have on your return. If you took a standard deduction, I know what that number is going to be, and I never have to come see JW. Mm-hmm. Where they find they have issues on individual returns, the fudge occurs with itemized deductions, and usually it would be things like charitable contributions. Did people overstate their charitable contributions? And if you've pushed the standard deduction high enough, then you don't have to worry about somebody fudging on the charitable contribution because the standard is that much higher. So that's really the trend. They've also tried to add a few more dollars in North Carolina to what child exemptions or child tax credits would be. So that, of North Carolina, that would be the big thing. The one little nuance that would be a nugget that would be different, and there's, you've got to make sure you meet the criteria, but North Carolina, and they made it retroactive back to 21, will start exempting fully retired military pensions. So we've got a huge military presence with Bragg and Lejeune and Seymour Johnson in North Carolina. And, I don't think there would be anything wrong, obviously, with folks coming down here with military pensions and retiring here. I mean, that's actually probably smart. Absolutely. But North Carolina now is going to start exempting fully retired military pensions. That's the bigger. Yeah, that's right. That's right. But North Carolina used to exclude, other $2,000 or $4,000 a year of everyone's, retirement benefits, and they did away with that several years ago.
It's interesting. We talk about these things. There is this balance between the state and federal, and I think what you pointed out is what I keep hearing is that North Carolina is in a good situation as it relates to taxpayer benefit. That a lot of states are much more, should I say, harder on the taxpayer than North Carolina is, and the trend keeps going in that kind of conservative mentality thinking.
Well, I mean, there's certainly been a trend to be a more business-friendly state, I think, and CNBC, I think, was the one that just did their recent survey, and North Carolina came in at number 1 in terms of business-friendly environments. Being business-friendly isn't always individual taxpayer-friendly. I think people would like to have, a Florida-type system where you got no income tax, but there's always a trade-off. I mean, if you have a low income tax, do you have a high sales tax? Do you have a high property tax? So they're going to collect their revenue. I mean, North Carolina's been, I think on the kind of the leading edge of trying to do some things. And so I think we're probably better positioned, but make no bones about it. I think that's because we've got a pretty educated workforce around the Triangle and Charlotte. And, we've got a lot of well-educated workers here. And I think that's been part of our reason why we've been successful.
We're going to go to another break. And when we come back, I want you to kind of talk to us about the tax changes and key amounts for 2022 on the federal level, because there has been some changes there that folks need to be aware of. And as we're talking about this, I would remind folks that, we're going to give them your number, and if they don't have a CPA or they need a financial planner, they can certainly reach out to you. But a lot of this in the first half, they ought to discover that they're going to need to talk to somebody. Ladies and gentlemen, we'll be back in a moment. Stay tuned. We're talking with Michael Chestnutt about financial planning, taxes, issues that affect your life.
Eastern North Carolina is a beautiful place where we gladly choose to call home, and we strive to provide the best communications services. STAR is committed to improving communications to all our service areas because we want to improve the communities where we not only work, but also live. STAR Communications. We are neighbors serving neighbors.
Let's get out of here.
Protect what matters most in your life with security from STAR Communications.
Ladies and gentlemen, welcome back. Thank you for being with us today. We Should Know is on there. We come to you STAR Communications TV, Channel 16, WCLN Radio, simulcast on Tuesdays at 2:30. We're talking with Michael Chestnutt, certified public accountant, also a certified financial planner. Michael, you're now doing financial planning, but we're touching on some things from your accountant side to kind of help us with for 2022 when folks look at their federal income tax filing. What are some of the things they should expect 2022 that they didn't maybe see in 2021 or 2020 or 2019?
Yeah, I guess the biggest thing is obviously there was some goodies that were added in there for 21 that probably won't be there or aren't going to be there for 22. You had things like advanced rebate credits. Then if you didn't get your money in advance, you had the opportunity to get the credit on your personal return. That won't be there for 22. It was there for 21. There was some really, eye-opening numbers last year on 21's tax return for people who had things like dependent care credits. They really juiced the system when they pushed the credits up on things like dependent care credits and child tax credits and such. Those numbers will revert back to essentially what they would have been in 20. So I'll give you an example. You could have gotten up to $8,000 for a dependent care credit on your return in 2021. And I saw some, $7,500, $8,000 numbers. I mean, daycare is very expensive. I'm not telling your listeners anything they don't know. I mean, it's very expensive. But usually the federal credits have been capped to $600 for one child, $1,200 for two children. But those numbers got ballooned all the way up to $8,000 for two kids or more. So that was a healthy change that will revert back to the old rules for 2022. Child tax credits went from $2,000 for a child that was under the age of 17, $500 for a child that was over 17. Those numbers went all the way up to $3,600 last year. Plus, you had the ability to get half of it up front, which was a reconciliation nightmare for us. Just another reason why I'm not doing it anymore. But those types of things revert back to the old rules. So you're back to the $2,000 per child under the age of 17, $500 for child or other dependent above 17. So you won't have that. May generate some surprises. So if you were expecting a big refund based on those credits last year, and those credits aren't as high this year, then you may end up with an adverse tax consequence on your return. So that's probably the biggest overall change at the federal level, because the difference between 21 and 22 as it relates to income and deductions and things like that are mostly the same. There have been some changes in charitable contributions. For folks that did not itemize last year, you had this charitable deduction for non-itemizers. You may have taken it yourself if you didn't itemize, but essentially we get $300 for a single person, $600 for married filing joint, even if you did not itemize. So generally when I mean itemizing, you take all of your itemized deductions, which typically is going to be medical, mortgage interest, property taxes, charitable contributions. Those are the biggies. And you compare it to what the federal would give you for standard deduction, and you take the greater of those two numbers. If you took a standard, then you got the benefit of, or no benefit of, making charitable contributions. So to try to give you an added goodie, they gave you $300 for a single or $600 for married filing joint. That's gone for 2022. So you won't have that as an additional itemized or an additional standard deduction, if you will, this year.
And the reason it was there in 2021 is primarily built around COVID and all the needs that was going on. And
I think it was a way of again, trying to push money out into the system. I mean, if you look at the theme of 21, almost everything was related to COVID. You know, getting more money back out in the system, whether it was people who were benevolent and gave money away. And you still had to document your charitable, don't get me wrong. So if you didn't make a contribution, technically you weren't supposed to get it, although almost everyone took it. But I think that's what it was intended to do.
The movement of this is staggering when we think about it. But ultimately, end of the day, is the average person that's paying taxes. They're going to continue to pay taxes. There's no way around not paying your taxes. Is that a true statement?
Ask Wesley Snipes.
Yeah, it's just there.
You're going to pay them. It'll catch you. I promise you, it will. Ignoring it is a bad idea.
And you don't necessarily have to have received a 1099 if it's something that's money's changed hands, no matter how small, it could easily be discovered.
Well, I mean, if you receive it, unless there's an exclusion, I mean, it's income. I mean, so just start with that. But I will say, whether you like the government or dislike the government, they, for the most part, do a good job of keeping up with how much you've paid them and how much has been reported to you. Mm-hmm. They might get some of the other details wrong, but that part they'll catch up to you.
And a lot of that is just analytics and computer, especially today, computer technology gives them that access to be able to do that.
Well, they're working with SAS now, so they're doing something.
So there you go.
Yeah.
There you go. And I think that's the thing maybe folks kind of have a misperception about. Well, you know, we're going to do this and we're just going to do this in $20 bills. Well, at some point in time, they're going to figure that you couldn't have bought that car unless you got a whole lot of $20 bills and there's no other income shown.
Yeah, well, certainly. I mean, if you look at the key areas, I mean, if we mentioned going from an itemized deduction scheme to a standard deduction, raising those levels, they can, you know, redirect their resources to other places. And if you look at it, I mean, they want more transactions to be reportable, whether it's by credit card companies with this new 1099K thing that they have to report, or whether it's a 1099 for monies that someone would have paid you as an independent contractor. They want as many tracing documents as possible because they know if it's traced, your chances of getting away with it are much smaller. And so they get to redirect their resources to businesses that are more likely to get cash or non-traceable monies. And so, I mean, it's smart. I mean, it's a good allocation of resources on their part.
And I think it's a serious thing to discuss because at the end of the day, we've seen in news reports and others where people have literally been marched off to prison for some years for trying to do some of these things.
Yeah, I mean, no question. I mean, like I mentioned earlier, I mean, this is the one thing in our system that you're guilty until proven innocent. I mean, it's just the way it works. I mean, the presumption, if they come in to do an audit, most likely what they're going to do is look at all of your bank records. Again, if it goes through your bank statement as an income item, unless you've got it on your return or there's a reason why it shouldn't be income, they're going to consider it as income. And that's one of the techniques they use if they ever audit you personally.
And again, it's all analytics, easily traceable, easy to look at. So just trying to warn folks, just be careful out there as you maneuver this landscape. And it circles back to what we talked about when we started opening the show today is you need to reach out and get you a certified person that does this, that understands the analytics. Even with that, if you don't let them know what's going on, you could still be in trouble.
If you try to use TurboTax or Tax Act or H&R Block software online, I'm not saying you can't get the right result. I mean, I almost think it would be just blind luck if you had any complexity and you got the right result.
It just doesn't make sense to try to go, which again circles back to something we were talking about. Is it really important for folks to understand anytime you hear the government say they're going to give something or do something, it can't do that without your money? It don't function without the taxpayers' money.
It is certainly all of our monies.
Thank you.
But, you know, unfortunately, we have to have some system that I think people understand and have trust in. But, most folks pay their taxes on a W-2 as withholdings. Mm-hmm. And so for the most part, 80, 90%, that's just my stat. I don't know what the stat is. Mm-hmm. Most folks are going to pay their taxes throughout the year.
Yeah.
Small business owners most times have to pay quarterly estimated taxes and different things that may go along with the business taxes that they would have. So you've got opportunities for all sorts of problems there.
Yeah. And you need to know what those deductibles are, which then should start having you a mental picture of acceptability. I think that's always been my problem is when you have to pay those taxes, you're going, what? When did I make? And a lot of people, that I've talked to would say, they would tell you how tortured they are sometimes when they get their paycheck and a third or what have you is gone. And they see something that says FICA and they're going, oh my, what is that? Well, they know it's federal government. And at the end of the day, that's troubling to people. But the other side of it is, and there's a lot of programs beyond the military that have to be funded through the government, and the government does not make money. Is that a fair statement?
Not all programs are bad. Not all programs are great. I mean, not every dollar that goes to the government is used wisely, and not all is used poorly. But all I know is I'm going to do the best I can, and I want to keep them out of my checkbook as much as I can. Absolutely. But I'm going to pay my fair share. Let's put it that way.
Absolutely. And I think at the end of the day, that's what everybody, I guess, has to accept. I mean, I don't think they need to. You got to accept that if you live in this country and you have profitability in this country, then you're going to have to pay for what is seen as the assets of this country.
Yeah.
And that's state, local, and federal.
Yeah. Well, certainly assets are very important. And so, I mean, you've got to protect them. That's part of the reason why I moved into the financial and estate planning side of things. I want to help my clients keep as much of what they've made as possible.
And in this new, not new area, but this area you've decided to focus on, it sounds like for the rest of your career in financial planning and estate planning is something that folks could benefit from by simply sitting down and having a conversation with you that may help them going forward with whatever tax issues they have, because there's things they can do financial planning wise that could help them. So when we come back from this break, I'd like to kind of talk about some of those things, plus touch on capital gains a little bit. That's something that's also part of the picture that unless you get hit with it, you really don't totally understand how bad that hurts. Is that a good way to break to go to the next segment?
It is a good break, although capital gains for most people aren't as big this year. How about that? The stock market has been in the toilet.
Yeah, and I think that's the big concern that folks need to understand. You might have it, but if you do this with it, then you might not have part of it, that's for sure. So we'll be back in a moment. Ladies and gentlemen, we're talking with Michael Chestnutt about financial planning and public accounting stuff, things that you need to know that'll help you in your everyday life and in your future. We'll be back in a moment.
To get the most out of your electronic devices, you need a strong internet connection and a protected home Wi-Fi network. You need high-speed internet from Star. Star has the fastest, most affordable high-speed internet service available for all your devices. We have no long-term contracts or high-pressure sales. Our service speaks for itself, and switching is hassle-free. We take care of everything with free installation from a local company. High-speed internet from Star. Internet at the speed of life.
Honey, do we pay our bill?
What bill?
The Star Communications bill.
No worries, honey. With Star's paperless billing and automatic draft system, I get a notification sent right to my phone. There's no need to be bothered with those paper statements, and our bill is paid on time every month.
Well, that's easy and convenient.
It sure is, honey.
Honey?
Yes, dear.
The baby.
Oh, right.
Ladies and gentlemen, welcome back. Thank you for being with us today. I want to remind you can reach us at weshouldknow.edu@gmail.com, weshouldknow.edu@gmail.com, or Post Office Box 1482. Drop us a line. Let us know what you think. Give us some feedback. Good to talk to a lot of folks. When I see you on the street, sometimes you'll tell me you saw the show, whichever one it was, and what benefit or suggestions you have. It's always important to us. We're talking with Michael Chestnutt today, certified public accountant, also certified financial planner, that's taking a little segue into another segment of your world of analytics. When we went to break, one of the things I mentioned I'd like to get into is this whole world of capital gains and looking at it from different angles, should I say, from different lenses. Tell us what we need to know about capital gains as we go through life. We may have asset value in something, and whether it's stocks, bonds, whatever it may be, or building, and we decide to do something with it, or as you pointed out earlier, that hog farm.
Yeah, well, capital gains, I mean, a capital asset is kind of broadly defined, but if you look at it for most people that may be looking at something, it could be something as simple as the family farm. Just say a piece of land that mom or dad or grandma or granddad has been leasing out to someone for some time, and they've had it for forever. Let's say they've got $1,000 an acre in something that's now worth $5,000 an acre. So you've got $4,000 of embedded gain. If they've held it for a long period of time, you get a preferred tax rate. It's long-term capital gains. But those one-time anomalies end up creating adverse tax consequences on their tax return. So that's how a lot of people see it on their return. A lot of people also see it from the standpoint of folks have, brokerage accounts and other things that may generate, interest, dividends, and capital gains in there. 2021 was a great year overall. The latter part of 2020 was a great year overall. A lot of people, if you have mutual funds, would have received mutual fund distributions, which generate capital gain consequences in 2021. However, if you have anything that's been in the stock market, it's been about like the weather in North Carolina. You never know what you're going to get from day to day. Mm-hmm. And we've had a bipolar market pretty much all year long, and it's been a steady decline, or at least we've had 2 steady declines this year, with a couple, what some people may say is a bear market rally. So for me, what I'm seeing a lot of this year is not really capital gains per se, but capital reallocation, where people may have some losses embedded in their portfolio. Let's say mom decides she wants to sell the family farm, but she's got an investment portfolio over here with some losses. I now have the opportunity to take and sell something at a loss on this side to offset the gain that mom may have on the farm, or to set those losses up as something you could take in the future as a capital loss carry forward. Capital gains and losses this year, in my opinion, are as much about capital reallocation and giving you the ability to rebalance your portfolio with hopefully not a ton of adverse tax consequences, with setting yourself up as a cushion in the future to offset future capital gains when they occur, not if they occur, but when they occur. So this year, you should have had opportunities. Back in June, it was ugly. We had a rally. Then it got ugly again. And we've had a nice little rally in the fourth quarter again, to the point that you've wiped out a large part of the gains if you stayed invested the whole time. But you were given opportunities during the year, if you were so inclined to do so, to take and sell something at a loss and go back into something similar, to set that up as something that will help you out in the future. So again, it's about portfolio positioning this year, where last year it was about mitigating, damage related to capital gains. So for me, it kind of works hand in hand, trying to look at your assets that we're planning for. Taxes are a piece of it, but you're also trying to look at it as a possibility of reallocating some of your resources from things that may not be working as well into things that you think will be working better for you in the future.
I want to just kind of stop it at this point and let you give us a contact number that folks can call you if they're hearing some of this conversation today and they're thinking, man, I need to follow up and clarify something. Did I hear that right, or I didn't hear it right? Have you got a number they can reach you?
Yeah, our physical office is 403 Johnson Street, just below the YMCA. Our direct line is 910-490-1118. And again, we'll have somebody there 8 to 5.
Okay, and we'll post that. We'll post that number on the screen and contact information, because I do believe a lot of the things that we're talking about are so deep, and a lot of it is individually determined anyway. We're just talking general, so I want folks to understand that. Just if you hear something and you're thinking about doing something, or if you have done something, it's still good to clarify it and make sure there's not another alternative that could be taken. And
one of the goodies, and not to circle back on the tax piece of it, but timing and your other income for once in a lifetime or rare type of capital gain transactions, you actually can end up with 0 tax consequences on your federal return. So for instance, if somebody was in the 12% tax bracket and they had a long-term capital gain transaction that occurred that added to their other income, as long as they didn't leap into the next bracket overall, that transaction may be taxed at 0% rate on FIT. It's taxable in North Carolina.
Yeah.
So understanding, again, what is income, when is it income, and how it's taxed,
and what bracket you're in.
And what bracket you're in makes a huge difference. And so, it's one of those things. Asking the question before you pull the trigger may pay huge dividends for you.
Yeah, even if you have to wait 6 months or a year, it may make a difference.
That's true. Yeah.
Let's talk a bit about what you would consider as a financial planner. What folks need to think about is good components of a financial plan.
Well, I think, it's pretty straightforward. And I think if you boil it down to its base levels, it's pretty straightforward stuff. The first step is you kind of have to figure out where you are, what you have, what are you working with. My number one thing I tell people all the time is you have to give me a time frame. Okay. Mm-hmm. What are we talking about here? So, if you're doing a goal-oriented plan, how much are we starting with? How long are you going to give it to work? How much are you going to allocate to it? But you've got to give me the time frame of which we're going to. Time is going back to what your grandma or granddad would tell you, time fixes a lot of things, and it makes almost everything work in the investment world.
And I think the other thing when I think about that is even if it's a CD, even if you're just looking at a CD at a bank, if you can look at it and say, well, I can not worry about that money for 5 or 6 years, your CD rate is going to be significantly higher than you've got it in, a fund that's successful every 6 months. So it's all relative because it's all an investment.
Yeah, I think you have to start breaking it down into pieces then. From the standpoint of money I may need today, money I may need in a relatively short period of time, say 3 to 5 years, and money that I could allow to work for much longer periods of time. And what people view as risky today over a long-term time horizon is actually, it's inverse. What is risky today is less risky over time, and what is less risky today is actually more risky to you over time. And we're living in it right now, and most people don't. They see it, but they haven't factored it into their decision-making. Inflation is the number one thing that most people don't consider when they're taking into consideration what they're going to invest in. Let me ask you a question. If it's costing you 7% more to do something right now and you're satisfied with a 3% rate of return, should you be happy with that?
Wouldn't think so. All
right. Well, that's kind of what you're doing when you're making a decision with long-term money and putting it in a CD, for instance. Yeah. So if I'm going to roll a CD for 30 years and I'm going to trail inflation by 2 or 3 or 4%,
you're going nowhere.
You're not. You're backing up. You're backing up. So again, time is. You have to take that into consideration. What I hate to see people go 100% cash when they retire because they're scared to death. Okay, you're probably. Unless you have very few assets. You're probably not going to spend all of your resources at one time. I hope you don't anyway. And so if you think about it from the standpoint, I probably have longer than 5 years for some part of my money, then I have a longer period of time to allow that to go up or down, but most likely up over a longer period of time. And so if you're just investing in what you perceive as safe, then look at what eggs cost today versus 3 years ago. Yeah. Okay. Yeah. That same concept, when I'm investing in something that's not keeping pace with the inflation rate, I'm backing up. I'm losing purchasing power.
Yeah. And I think, one of the things that we have talked about a lot of issues today, and I want folks to understand that we've just basically touched on a lot of these. We've looked at a lot of suitcases. We really haven't got into unpacking a whole lot of it. We have not even got into looking at the estate plan as it relates to wills, as it relates to trust, as it relates to the kinds of things that folks need to. Early on, I would say, Michael, they need to early on in life start thinking about that and determining how many children do I have? Do I have children? If I don't, what about spousal responsibility? We haven't talked at all about home health care, nursing home care, which is unbelievable now. Should you get insurance? Those are the kinds of things that you're willing to talk to folks about that deal with their specific situation.
We're fee only. I don't sell any products. So,
right.
I don't sell insurance or do anything along those lines. But I think the average person probably sits down and thinks that estate planning is just for the high net worth. Everybody should consider something as simple as having a will, or maybe a power of attorney. If something were to happen, you were incapacitated, somebody could act in your stead, or healthcare power of attorney. Everyone needs to consider financial planning in some capacity and start with the basic stuff. But really and truly, it's one, if you sit down, you could avert some problems later on for your family members if you were to just take a few minutes now and try to jot some things down. I can help you walk through the process. We'd have to get an attorney to document the plan, but you do need it documented.
Give us that telephone number again.
910-490-1118.
You got the number, ladies and gentlemen. And Michael, I want to thank you for being with us today. This has been a very interesting discussion. I think it's something that folks are going to find extremely worthy to follow up on. My hope is that our conversation causes them at least to reach out to you or somebody in your business to help them through the process. Again, thank you for being with us.
Absolutely.
Ladies and gentlemen, thank you for being with us today. We look forward to hearing from you. And listen, stay tuned. Each and every week at 2:30, We Should Know is on the air. And as always, may God bless.
Thank you for tuning in to this week's episode of We Should Know with host JW Simmons. If you have a question, comment, or suggestion regarding this or any episode, please send your emails to weshouldknowedu@gmail.com. And remember to tune in every Tuesday at 2:30 for another informative episode of We Should Know.